And now let's talk about the economic profit versus accounting profit. So the economists measure firm's economic profit as total revenue minus total cost. It means total opportunity cost. If I say total cost, you automatically assume in economics that I'm talking about total opportunity cost, which means implicit cost plus explicit cost. Right here, implicit cost versus explicit cost. The accountants measure the accounting profit as total revenue minus just explicit cost. And it makes sense as well, because whenever there is judgment involved, then there is a chance of fraud, right? So the accounting, it measures only total revenue minus only those costs which has a direct outflow from the firm, not the indirect costs. Okay? For example, implicit cost, for example, opportunity cost of the owner working for somewhere else, or foregone opportunity of not working with Wall Street, right? But economics does include that. So here, when total revenue exceeds both explicit and implicit, then we say that this is economic profit. Normally, we don't have any economic profit. Why? Because implicit cost is also included in total cost. So number 2 point is economic profit is smaller than accounting profit. You agree? Because accounting profit includes only explicit cost, while the economic profit includes both cost, implicit and explicit. So in that case, the economic cost going to be higher than accounting cost. So economic profit is smaller than accounting profit. So everybody understand that?
Yeah.
Okay,
Yeah.
good. Here we go. So we have formulated one diagram here. That is, when an accountant view a firm, it views accounting profit as revenue minus explicit cost. So see the chunk of a cost in total revenue of a firm, only explicit cost. While in economics, the economist, he views a firm like that he minus from the revenue explicit cost and the implicit cost. Both, when you add both implicit and explicit, you get total opportunity cost. Remember, implicit cost is called opportunity cost, but total opportunity cost is, sorry, my bad. But the total opportunity cost is here we go. Total opportunity cost is implicit plus explicit. Or you can say that explicit plus opportunity cost is equal to total opportunity cost. Understand? Everyone, please. Sunho,
Yeah.
Rodrigo, Pinjo.
Yeah.
Yeah.
Good. Good, good, good. Okay, if you understand that, then answer this question. It should be very quick. That economic profit what is the answer here?
A.
Pinjo, Sunho, Marilyn,
Yeah, I'm here.
Jody,
A.
answer this question. Well done. A. Now this is the most practical question, most exam-like question. There we go. Let's discuss that. So I'm going to give you 2 minutes to read that, read this question. So what is the answer here? Calculate, everyone.
D.
A.
D.
He say A. Some say B.
I said D.
Okay. Anyone else?
I say C.
C. Anyone who
B.
thinks B? Okay. Let's do this question. So in this question, it will further clarify your knowledge regarding the. So here we go. Joe wants to start his own business. The business he wants to start will require that he purchase a factory, cost 400,000. Joe currently has from his bank 500,000 in the bank and he's earning 3% interest, right? Okay. If Joe purchases the factory with his own money, what is the annual implicit cost of purchasing the factory? If your answer is why is stuck here? Okay, if your answer is C, then you are in good shape. And why the answer is C? Let's discuss that. So it means those who say A, not good. Those who say D, not good. Let's talk about this. So if he purchases from his factory, he has to spend $400,000, right? And if he did not purchase the factory, he would be earning $12,000 on $400,000. So what is the annual implicit opportunity cost that he loses from purchasing the factory? 12,000, not 15,000. 15,000. Why? Because 15,000 is the amount of interest that he is receiving right now before the purchase of factory. Right? So those who answer D, the wrong answer. Why? Because the factory cost 400,000 and the amount he will lose, he will invest is 400,000. It means 100,000 still there and he would earn this 3%. Right, everyone?
Yeah.
Yeah.
Okay. Let's move. What? I need to clear this annotation as well. Here we go. Now, the drawings here. Now, scenario 2. Please read that. Scenario 2. Read that. Suppose Joe purchases the factory using $200,000 from his own money and $200,000 borrowed from the bank, paying 6%. What is Joe's annual total opportunity cost of purchasing the factory? So remember, what is the formula for total opportunity cost? Implicit cost plus explicit cost. What is the explicit cost? He purchases the factory and he has to pay interest. How much interest he has to pay? He borrowed 200,000 and he would pay 6% interest. Sorry. He would pay 12,000. Right? What is implicit? 200,000 he would be taking out from his bank account. In bank account he has 500,000, right? So 500,000 he has ample money, and 200,000 he would be taking out from the banking, his own personal bank, and he would be left with 300,000. So how much income he loses? He would be earning 3%. Right? So that's why the answer is 18,000. So you understand, guys, everyone? If you don't understand, I can repeat. Sunho, David, Faik, Kim,
Clear.
Isaac,
Yeah, I get it.
Miria, Nam, Pinju, Rigo.
Yeah.
Okay, that's why the answer is D. Right? Now for this question, please take a picture. And then I'm starting a breakout room in which you guys can discuss and give me the answer. So here we go. I am making 3 breakout rooms. Please take a picture and then answer this question. Kim, please join. And Osama, please join.
Yes, I'm trying.
What happened, Osama?
I have really bad network today. I don't know why. And it's still, I cannot use that platform. I'm gonna share a picture.
Okay.